So, what actually is Forex trading? Well, to understand what Forex trading is, first we must understand what the Forex market is. FX or Forex is short for foreign exchange, and the foreign exchange market is the global marketplace in which a nation's currency is exchanged for that of another at a mutually agreed rate. So, it is a decentralized network of both buyers and sellers that allows individuals like ourselves, such as traders and investors, big financial institutions such as hedge funds, pension funds, insurance firms, and banks, as well as commercial businesses, to convert one currency into another for a variety of different reasons, such as commerce, tourism, or just pure speculation. So, if you have ever traveled to another country, it's pretty likely that you've converted some of your local currency into another currency, and therefore you have already participated in the Forex market. If you take a trip from America to Italy and you convert your US dollars into euros, when you do this, the exchange rate between the two currencies, based on supply and demand, determines how many euros that you get for your dollars. And this exchange rate is fluctuating continuously. A single dollar on Wednesday could get you 1.11 euros, and on Thursday, maybe 1.12 euros. Now, this tiny price difference may seem insignificant initially, but think of it on a much bigger scale. A large international company, they may need to import goods from abroad or pay their overseas employees, and imagine what that could do to their monthly net profit if simply exchanging one currency for another costs you more depending on when you do it. These few small price differences, they add up pretty quickly when you are dealing with significant sums of capital. Now, while a lot of foreign exchange is done for practical purposes like that, a lot of it is also undertaken by Forex traders with the aim of earning a profit from these fluctuations in exchange rates. And the amount of currency converted every day can make price movements of some currencies extremely volatile. And it's this volatility that can make FX so attractive to the traders. Now, with asset classes, say like stocks or commodities, they are generally traded through a central exchange. So, many US stocks, they are traded through the New York Stock Exchange. But unlike stocks or commodities, there is no central exchange for trading Forex. Instead, currencies are traded via an electronic global network of banks, dealers, and brokers. And as a result, the FX market is open 24 hours a day, 5 days a week, only closing down on the weekend. The only market to eclipse this is the cryptocurrency market, which is open 24/7. So good luck getting any rest with that. Now, fiat currencies, they are traded worldwide in 4 major financial centers in different time zones. The market opens in Sydney, and then moving into Tokyo during the Asian session, and then before it opens up in London. And this is when you start to see a lot of the volume coming through, but before the session finally ends in New York for the day. So as I was saying, the London and New York session is where and when the majority of the trading volume goes through the market. And this is pretty much when you will, pretty much nearly always see the biggest amount of volatility for the day during those 2 sessions. But this global market, it's made Forex trading extremely attractive as it allows traders to capitalize on opportunity and have the ability to sustainably build their wealth around the clock, no matter what their own personal time constraints may be. The FX market is the largest, most liquid market in the world, with a staggering average daily trading volume exceeding $6.6 trillion. Just to put that into perspective, all of the world's stock markets combined do not even come close to this. The entire US stock market, it only turns over $250 billion of daily trading volume. Now, the scale of the Forex market, it means that liquidity, so the amount of buying and selling volume happening at any given time, is extremely high. So from the perspective of a trader, liquidity is very important because it determines how easily price can change over a given time period. A liquid market environment like Forex, it enables huge trading volumes to happen with very little effect on price or price action. So what is actually traded in the Forex market? Money. Forex trading is quite literally the act of buying money, waiting on a shift in exchange rates, and then selling it back to the market at a later point in time, ideally for a profit. So think of it a bit like eBay, right? You want to buy something nice and cheap, and then you want to sell it on to someone else for a much higher price, locking in the difference for a tidy profit. That is literally your sole aim as a trader, to buy low and sell high, or vice versa. That's how you will make money. Sounds simple enough in theory, right? But the trillion-dollar question is, how do you actually determine the true value of an exchange rate so that you know you are actually buying it when it's cheap and undervalued, and then that you know you are selling it back to the market high when it is overvalued for a nice profit? How do you know that? Well, there are an endless amount of methods and strategies that traders use to try to determine this. There is literally a million different ways to make $1 million in the market. But the strategy that you choose to answer that question ultimately is your trading edge in the market that you have over others. Now, your trading edge is what you're going to learn how to develop in this course, and it all comes down to you mastering these 4 absolutely fundamental skills. Understanding basic human behavioral tendencies, understanding basic mathematical probabilities. Don't worry about this, the maths is literally super easy. Don't worry about that whatsoever if you're not a big fan of maths. And then number 3, understanding basic pattern recognition. So looking for the same things happening again in price action over and over again. And then finally, which is probably the hardest bit and what may take the most time, is understanding how to transcend your own emotional reactions through strategic foresight and master planning. Mastering these 4 skills is how you will extract profit from the market on a consistent basis. This is the journey you are about to begin.